In Lesson 2.2, we dealt with the capital markets as they relate to fixed income securities. Now in Lesson 2.3, we will begin to deal with the capital markets as they relate to equities. Our discussion of equity market securities will encompass a discussion of both preferred shares and common stock or common shares. Each of these types of shares will be discussed in more detail in the slides that follow. First, we'll look at how preferred shares work. One of the first things that we note about a preferred share is that a preferred share has what we call a stated dividend. This means that there's a promise of a certain amount of dividend that will be paid each year on this preferred share. The dividend can be stated either as a dollar figure, so for instance we can refer to a preferred share as ABC Company $1.25 preferreds. That means that the dividend that will be paid on these shares will be $1.25 per year. Or we can refer to it as a percentage of the share's par value, in which case we would say that it was an ABC Company 3% preferred, which means that the dividend that is promised each year is 3% of the par value of the share. We'll talk about par value in a moment. Now, one thing to note with regard to the dividends on preferred shares is that although they are stated or promised, the company does not have to pay the dividend to the preferred shareholders. In practice, however, companies usually will do whatever they can to make sure that they do pay the preferred shareholders their dividends. However, it's important to note that these do not have to be paid each year. It's up to the board of directors whether they get paid. Now, the next note refers to voting power. In the case of preferred shareholders do not have voting power. This means that when the company calls an annual general meeting of the shareholders and the shareholders are to vote on certain issues, the preferred shareholders do not get a vote. The next note is that preferred shares have what we call preference as to assets and dividends. This means that with regard to the preference as to assets, if the company were to go bankrupt and had to liquidate their assets to pay off their shareholders and creditors, the first people to be paid would be the creditors, which would be the bank and the bond holders. The next people to be paid would be the preferred shareholders, and then the common shareholders receive whatever is left. So the preferred shareholders have preference as to assets in relation to the common shareholders. The same is true of dividends. We also say that preferred shareholders have preference as to dividends. This is because preferred shareholders must receive their dividends before common shareholders can be paid dividends. The fourth point is that there is more risk with preferred shareholders than with a bond from the investor's standpoint. This is because the dividends do not have to be paid to the preferred shareholder the way that interest on a bond has to be paid. You will recall from our discussion of the fixed income securities that bond holders must be paid the interest or the coupon payment on their bond each year. If they do not receive that interest, they can force the company into bankruptcy. This is not the case with dividends on preferred shares. The next point is with regard to the preferential tax treatment of dividends. Dividends that are received either by preferred shares or by common shares receive what we call a dividend tax credit that reduces the amount of tax that you pay on dividend income. This is different than the amount of tax you pay on interest income, because interest income is taxed 100%. Preferred shares can also have what we call a stated value or a par value. This is essentially a face value for the share. If the preferred share has a par value, it would be reported in that way in the newspaper. So we would refer to, for instance, an ABC Company $50 preferred. That would mean it had a $50 face value. This means that in liquidation, this is the amount of money that each preferred shareholder would be entitled to. Our final point with regard to preferred shares is that most preferred shares are redeemable. This means that the company who has issued the shares can call those shares in and retire them, whether the holder of the share wants to do so or not. This is a feature that is not to the benefit of the shareholder, so as a result, people purchasing a redeemable preferred share would be willing to pay less for that share. When we talk about preferred shares, there are a number of different types of preferred shares, each of which has its own characteristics. Each type of preferred share would be of interest to an investor for different reasons. So different investors would be interested in different types of preferred shares, and different types of preferred shares would be more beneficial at different times. The next two slides present to you 6 common types of preferred shares. So I will go through each one as they appear on the slide. The first one is what we refer to as a straight preferred. This is your bare bones preferred share. It has no special attachments to it. Basically, a straight preferred pays a dividend, a fixed or stated dividend. We say that it trades on a yield basis. This means that much like a bond, when interest rates go up, the value of a straight preferred goes down. When interest rates go down, the value of a straight preferred goes up. A straight preferred acts like a bond because the straight preferred has a fixed or stated dividend that doesn't change, just the same as a bond has a fixed or stated coupon rate that doesn't change. So when we require a higher yield on either type of investment, the only way to increase our yield is to pay less for it in the beginning. Or vice versa, if we require a lower yield on either type of investment, the only way to reduce the yield is to pay more for the investment at the beginning. Finally, with straight preferred, they have normal asset and dividend entitlement, which again just refers to that preference as to assets and dividends that we spoke of on the previous slide. The second type of preferred share that we will deal with is called a convertible preferred. This has a special feature attached to it. It acts the same as a straight preferred. It still has your dividend, still has the same asset and dividend entitlement, but it has an added feature, the convertible feature. And what this allows the investor to do is that they can hold the preferred share, but they also have the ability to convert that preferred share into a stated number of common shares by a certain time frame. This is a benefit to the investor because it gives them two options. They can either hold the preferred shares, or if they feel that the company is going to grow and they want to benefit more from the growth of that company, they can then hold the common shares. Because the feature or the type of preferred share is to the benefit of the investor, they will tend to pay more for that type of preferred than for a straight preferred, and therefore the yield or the return on a convertible preferred will be lower than the straight preferred. The third type is what we call a retractable preferred. This means that, again, it's a preferred share with the same dividend and asset and dividend entitlement, but it has an added benefit in that the holder of the preferred share can choose to mature that preferred share early in a way. Basically, the preferred share does not have a maturity date on it, but there's a retraction date. So the holder of the preferred share can force the issuing company to buy it back. Next, we have variable or floating rate preferreds. And the variable or floating rate refers to the dividend. When we talked about straight preferreds, we talked about the fact that they had a stated fixed dividend, whether it be paid or not in any given year. With variable or floating rate preferreds, the amount of the dividend will change as interest rates change. So when interest rates go up, the dividend that the preferred shareholder will receive will be higher. When interest rates go down, the dividend that they receive will be lower. Because this dividend changes with the interest rates, a floating rate preferred will not change in value the same way that a straight preferred will when the interest rates change, because the interest rate change is being reflected in the dividend change, whereas it is not with the straight preferred. The fifth type that we have listed is a participating preferred, and I mention here that they differ in dividend entitlement, and what I'm talking about there is that a participating preferred has a stated dividend the same as all other preferreds, but they also will receive an additional dividend if the common shares receive a dividend of a certain amount or more. So basically, We call it a participating preferred because they are participating in the earnings of the company along with the common shareholders if it's beyond a certain amount. Finally, the sixth type is the foreign pay preferred, and this refers to the dividend as well. It means that the dividend in this case will not be paid in domestic currency, so in our case Canadian dollars, and is instead paid in another currency, a foreign currency, perhaps US dollars or euro. Now, just as there are different types of preferred shares, for each of the types of preferred shares that we previously have discussed, there are features that can be attached to those preferred shares. So any one of the 6 previous types of preferred shares that we've talked about could have any of these features attached to it. I've noted 3 different common features that can be attached to a preferred share. The first is the cumulative or the non-cumulative feature. A preferred share will be either cumulative or non-cumulative, and this refers to the dividends. If the preferred share is a cumulative preferred share, this means that if the dividend that has been stated is not paid in a given year, it will accumulate year after year until the dividend is paid to the investor. So if, for instance, ABC Company had a $1 stated dividend on their preferred, and in 2005 and 2006 they opted not to pay it, but in 2007 they were going to pay dividends to their shareholders, they would have to pay $3 in dividends total if the dividends were cumulative. They must pay all of the dividends in arrears as well as the current year's dividend. If, however, the preferred share is non-cumulative, this means then that if the dividend that is stated is not paid in a given year, it is lost. It does not accumulate. The next feature is the callable versus non-callable feature, also referred to as redeemable versus non-redeemable. This refers to the company's ability to call that preferred share in, or basically force the investor to sell it back to them so that they can retire it. When they do that, they recognize that the investor may not want to sell the share at that time, so they will usually call it in at a premium or an additional amount to market value. So they'll give 30 days notice, and if the market value of the preferred share at the time is $45, perhaps they will pay $46 to call it in. This feature is not to the benefit of the investor, so when you're buying a preferred share, if it's callable, you'll pay less for it than one that is non-callable. If the preferred share is non-callable, this simply means that the issuing company does not have the ability to call it in. And finally, we have voting privileges. I stated previously that preferred shares do not have voting privileges. They do not vote at the shareholders' meeting. However, it is possible for there to be a feature attached to a preferred share that will allow for the preferred shares to gain voting rights if a stated number of dividends has not been paid. So until those dividends are paid, the preferred shareholders are given the voting right. We dealt with yield calculations on T-bills and bonds. There's only one type of yield calculation that we will deal with on preferred shares. This is called the current yield. It's one of the easier calculations that we do, and it tends to be the one that students will always forget. Students tend to think that because it's easy they'll remember it, and then on the test they forget it. So I'll give you notice now to take note of this, because I will ask it, and I will ask it many times. The current yield is what we call an income yield. We call it an income yield because we are dealing only with the yield that the investment provides from the income that it pays to the investor. So in the example on the slide, we have an ABC Company $2.75 preferred selling for $29 per share. This means that this share pays $2.75 in dividends, and its market price is $29. The yield, or the current yield on that preferred share, is therefore 9.48%. Next, we'll turn our attention to common shares. The first note that I have on the common shares is that each share has one vote. In general, this is true. We do, however, have some types of common shares that have no voting privileges or restricting voting privileges. So we tend to refer to common shares as having one vote per share, but this isn't always the case. Common shares generally do not have a par value or stated value. There are some that do. This is a holdover from a time when we did have par values on common shares, but it's not common at this time for a common share to have a par value. Common shares can be split or consolidated. This means that if a company had 1 million shares outstanding that were selling at $10 per share, they could split those shares 2 for 1, in which case they would then have 2 million shares outstanding selling for $5 per share. The equity value of the shares that they have outstanding doesn't change. All this does is to reduce the share price of the shares, and this is essentially why a stock split would be done, because the company wants to be able to reduce the market price of the shares so that they'll be more advantageous to the customer or more interesting to the customer. On the other side, you can also have a share consolidation, which means that the opposite occurs. The shares are selling at too low a value to be of interest to the investing public, so the company decides to consolidate 2 for 1. So if you had 2 million shares outstanding selling at $5 per share, they would then consolidate them 2 for 1 and only have 1 million shares outstanding, now selling at $10 per share. With common shares, there's no guarantee of dividends. We've stated before that preferred shares have a stated dividend that may or may not be paid, and if it's not paid, it may or may not be cumulative. With common shares, there's no stated dividend, and there's no guarantee in any one year that a dividend will be paid. Some companies have a history of paying dividends, so the investors feel fairly confident that they will receive one. Some companies do not pay dividends at all because they are more interested in reinvesting that money into the company and growing the company. It really depends on at what stage the company is. So common shareholders have no guarantee in any year of a dividend being paid. We refer to common shares as having the highest degree of risk of the investments that we have discussed so far. There are other types of investments that have a higher degree of risk than common shares, but when we're comparing bonds, preferred shares, common shares, and money market securities, common shares have the highest degree of risk. This is because there's no guarantee of dividends, there's no stated value for the share. The share can go up and down in value according to market conditions, so the returns are purely dependent upon how well the company does. If the company does well, then the market price of the share will go up and the probability of receiving dividends will go up. If the company doesn't do well, dividends won't be paid and the market price will be reduced. Finally, we refer to common shareholders as the residual owners of the company. This refers to what we were discussing previously about when a company goes bankrupt, who they pay first. In liquidation, a company will pay their creditors and bondholders first. The next people to receive money would be the preferred shareholders, who would receive their par value. And then finally, the common shareholders receive the residue, or whatever is left over. So that's why we call them the residual owners of the company. Like preferred shares, there are different types of common stock. I will talk about 6 different types of common stock here that are listed on this slide. However, I want to point out that when we talked about the types of preferred shares, the type had to do with differences in the characteristic of the share itself. With the common stock, the different types have to do with the type of company that is issuing the stock or the type of industry that they operate in. So each of these types of common stock all have the same characteristics in that they have 1 vote per share, no stated dividend, no guarantee of dividend, they're residual owners of the company. All of that is still the same. The difference is in who's issuing the stock. So the first one is defensive stock, and what we refer to when we're referring to defensive stock is that the company is defensive in nature, in that when the earnings or business cycle goes into a downturn, the earnings of this particular type of company won't be affected as much. So types of defensive stock would be stock in a utility or stock in a pharmaceutical company. Both of those types of companies have provide a service or a good that people still need even if we're in a poor economy. People still need their heart medication if we're in a poor economy. People still need phone service if we're in a poor economy. So investing in a defensive stock will mean that your downturn will not be as harsh in a downturn in the economy. With cyclical stock, it's really the opposite of defensive. It means that the value of the stock will follow the business cycle. So when the business cycle is in a peak phase, the stock's price will be higher. When the cycle is in the trough phase or in a contractionary phase, the value of the stock will decrease. Third, we have seasonal stock, which means that during different seasons, the value of the stock will be higher or lower. That's because they have goods or services that are seasonal. Beverage companies is one that comes to mind. They tend to do better in the summer months when people are imbibing beverages more often. The fourth type of stock is called a blue chip stock. Blue chip stocks refer to companies that for the most part have been around for a while. They're sort of tried and true, have a history of paying dividends, have a history of asset value, and so on and so forth. So their return may not be as high, but they're sort of steady performers. Contrasting to that, we have the next type, which is a speculative stock. A speculative stock tends to be a newer company, newer technology. It's untried. We don't know for sure how well it will do, and that's why we call it speculative. You're speculating on whether it's going to do well or not. It's a more risky type of stock, and anytime we deal with risk, the higher the risk, the higher the potential return or potential loss. So a speculative stock is riskier. Finally, we have what we call a capital growth corporation. And what that means is that the stock issued by this company is issued by a company that is interested in growing the company. They're still probably fairly new, and rather than paying dividends, they want to reinvest those dividends so that the company can continue to grow. Unlike a blue chip stock that has a history of paying dividends and probably will continue to do so.